So jumping into kind of, you've gotten a meeting with an investor now, how do you pitch them? I wanted to outline kind of what I think are the big components of a perfect pitch deck. This is, again, a rough estimate. This isn't in any particular order, but in general, something around 10 slides is enough to convey the really important content without bogging down the investor and kind of giving them too much to read. So I think the first and most important part is clearly state the problem that you're solving and prove that people care about it. I can't tell you how many pitches I'll kind of get through where someone's giving me the background on a market and their team and blah, 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 and 20 minutes into the presentation, I still don't know what the company does and why it does it. So obviously, the next question is, within kind of the problem you're solving, convince me that that's a big enough problem that it's going to be an interesting outcome. Again, as a $1.6 billion venture fund, Bessemer is looking to fund companies that can return hundreds of millions of dollars. If you're meeting a small angel investor, the market size target for them might be lower. Then spend a little bit of time, obviously, talking about your solution, your technology, your product, whatever it might be. Some people get way too bogged down in this and kind of assume that as a venture investor who invests in the mobile infrastructure space, for example, that I'm familiar with every analogy and detail of how a mobile network works. Don't make those assumptions necessarily. Make sure to keep it at a high level and keep it simple. Demos can be really great and really helpful. A lot of them fail in the middle of the presentation. That's okay, but kind of be prepared and be ready to expect that and react to that. Then obviously the team is really important. We're judging the team throughout the entire presentation, but you definitely want to take some time to explain who the people are that are on board with your venture and what interesting qualifications they have. Have they worked at past startups? Do they have a really impressive technology degree? Have they had prior success as a founder, whatever it might be? You also have to talk about the business model for the company, obviously. You don't necessarily have to have the business model in place, but we certainly want to know that you've kind of thought through, let's say it's a consumer company like Pinterest. You don't have to be making money from day one, but we want to know that you've thought through how could a business like this make money one day. Competition is important. I'll get into some mistakes earlier, but every startup has competition, and it's important to kind of be upfront about who those competitors are and explain really clearly why you're better. And it's okay to say, you know what, these guys are a significant competitor. They have good technology. We have these 3 features that we think differentiate us, but they're out there and they're a threat. That's totally fine. That's the case for 99% of companies out there. If you have it, if you've already launched the company, great to share any data that you have on traction that shows how the business is working. On the next slide, I'll talk a little bit about what some of those metrics can be. And then finally, good to close with kind of some financial information about the company. Again, we're always interested if the company's launched. Are you making money? Is that revenue growing? Is that revenue, profitable for you? Things like that. Have you raised money in the past? What have you been able to do on the budget that you've had? So quickly, a couple mistakes that we see people do in presentations fairly frequently. I hate it when people tell me that they have no competition. That's almost. In fact, I'm just going to say it's never true. You may not have a competitor doing the exact same thing as you, but chances are someone has also seen this market and someone's also interested in it. And there's nothing wrong with that, but be upfront about it, because when I go and Google for your competitors later and find out, you're going to come across as looking a little bit shady. A lot of times people have ridiculous revenue ramps in their pitches. So if you're telling me that you think you can get to $100 million of revenue in 3 years, you're telling me that you're going to be one of the fastest growing startups of all time. And it's okay to be really confident in your startup, but it also tells me that you probably didn't think through very much the assumptions that underlie how you'd get there. So more importantly than showing a ridiculous revenue ramp, it's okay, you want to be ambitious, you want to show really ambitious goals, but you want to also show that you've thought through whether those goals are actually achievable. And so what I'm going to be looking at is not the kind of end number of revenue in 3 years, but how you got to that number, and if I think that your assumption of what your product will sell for and how many people you can sell it to and what your margins will be and things like that are reasonable. A lot of people, when they talk about their market size, make a statement like, mobile is a $20 billion market, and if we can just capture 1% of that, we'll be a huge company. So that's always a bad sign. We're looking for people who kind of know really well what their market is and know how they're going to get there. I'd rather hear that you plan on getting 50% of the market for mobile enterprise security than 1% of a really ambiguous market that you're obviously never going to capture a significant share of. Finally, a lot of people will ask to sign NDAs for their company. Venture firms almost never sign NDAs. The reality is that, A, ideas aren't worth as much as people tend to think. It's really all about the execution. And so if you think that you're the first person to come up with the idea for an Airbnb or for a Dropbox or whatever it might be, you're probably not. It's going to overwhelm the VC to sign all of these NDAs. So we don't really have the legal resources to do it. And finally, VCs are built on their reputation. And so if we ever did anything unethical, like take what you told us in an NDA and pass it on to a competitor, a portfolio company, start our own company, whatever it might be, that word would immediately get out there and we'd never be able to invest in anyone again. So keep in mind, people are going to reject you on an NDA. I've never heard of someone getting screwed by a VC firm like that. So I don't think it's a huge thing to worry about. So a little bit more about kind of in the context of this presentation, I just outlined what people are judging you upon. Again, a lot of what we're judging it upon is you. How well do you answer questions? How thoughtful are you? Do you seem like you're aggressive? Do you have have you demonstrated some scrappiness and ability to make something out of little resources, whatever it might be? From there, what we think about really depends on what stage the company's at. So if you haven't even built a product yet, all we can really think about is this a really strong team and are they attacking a really strong market? Once you've built the product, we can start to factor in, do we believe that these guys have built a great product? Does it look nice? Does it work well? Does it address the pain points in the market? And once you've launched the product, we can start to look at the results from the initial traction in the market and decide how attractive that is. So keep in mind that depending upon where your startup is, different things will matter more to the investor. I've mentioned the word traction several times. Traction could mean a lot of different things. So in the context of a software business or a mobile app or a consumer web business, it could mean things like the number of downloads of your app, the number of signups for your service, the number of registrations for your product. We look at things like user engagement. So for every 100 users you have, how many times do they come to your site or use your software? If they use it 10 times, is that 10 times within a day, a week, a month, a year? When they come and use it, what are they doing? Are they spending 1 minute on it a day? Are they spending 2 hours on it a day? Is the company making money? Are they, if you have a freemium model of the people who've signed up to use your product for free, how many of them decide that it's worthwhile enough to pay for it? What's the cost? What's the lifetime value of a customer? So does a customer spend more money with you over time or less? Do customers stick around for longer? Or do they kind of churn off very quickly? Do customers generate a high gross margin or a low gross margin? Someone asked a question about how we measure customer acquisition cost, which I can answer towards the end of this, but that's another factor that we think about in terms of this kind of, are the metrics and unit economics working right for the business? And I've linked at the bottom here to 2 resources from Bessemer, 10 Laws of Cloud Computing and 10 Laws of E-Commerce, where we talk about how we calculate things like customer acquisition cost, lifetime value, retention, and things like that. So it's really helpful if you have a software or a consumer business, gives you an insight into how we look at that, and those are both available for free on our website through those links. So I wanted to wrap up by talking about what to know about financing. So let's say you've finally gotten to the stage where you're going to be looking at deal documents. There are a couple things to keep note of. Again, I'm gearing this more towards people who are looking at kind of angel and early stage financing. So at the earliest stages, people often have a decision to make between raising a convertible note or a priced equity round. So a convertible note is actually debt, which can convert into equity if the business continues to do well and raise money in the future. A lot of people choose to raise convertible notes for early stage startups because it avoids the conversation of what's our investment worth or what's our company worth right now. So the way a convertible note will work is I'll give you $100,000 today. When you raise money a year from now, let's say it values the company at $10 million, my $100,000 will convert into equity in your company at some discount to that $10 million price. Deal docs for convertible notes are pretty simple, but if you kind of work out a deal where you're expecting to raise money in the future at $10 million, and instead you're forced to raise money valuing the company at $2 million, the equity, the dilution impact of that $100,000 investment that I made earlier is going to add on to it and maybe surprise you. It's also incredibly common. Almost any investor I've ever seen will have a liquidation preference in their term sheet, which basically means that they have the right to get their money out of the business before you realize any return. So this protects the investor in a downside scenario where the business doesn't do that well. They're able to get their money out first. That's called preferred stock. There's a second variety called participating preferred stock, which first lets the investor get their money back, but then lets them also share in all of the upside immediately after they get their money back. That's a little bit of a disadvantage to the entrepreneur in a situation where the company doesn't sell for a large amount of money, but if the company sells for a very high amount of money, the impact of that goes away. So it's often used as a way to kind of bridge the gap between an investor who believes, a founder who believes their company's worth a lot of money, and an investor who doesn't want to necessarily pay that high price, but is willing to if they kind of have some protection if the business doesn't work out as well as the founder expects it to. Very common in term sheets when VCs or angel investors invest, that you'll be asked, if you don't already have one, to create an option pool to hire future employees. Anywhere from 10 to 20%, I'd say, is pretty typical at an early stage. This typically comes out of the founder's stake in the company. So if you're thinking you're selling 20% of the company to the investor, you should also think about the impact of the option pool. We're also asking founders generally to vest their stock. So if you own 70% of the company after the investment, we're going to say you're not actually going to get that full 70% ownership until 4 or 5 years out from the investment. That's our protection of you kind of deciding, great, I've raised a bunch of money, but I'm bored of this now, I want to leave, and yet I still own 70%, and we just lost the CEO that we really liked and wanted to invest in. I'm going to skip talking about the protective provisions. If anyone wants to ask a question about that, I can go into them in a little more detail, but other things that you can be aware of. Venture firms will ask for rights to get their investment back after a certain period of time. They'll have rights on kind of making future investments or blocking future investments. They'll have rights that allow them to get a little bit of protection if the company has to raise money in a negative situation and things like that.